Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Tuesday, August 29th, 5:05 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. Change in the state of the market to uptrend, as today we had a day 8 follow-through day according to the O'Neill rules. We look for, after the market is correcting and it puts in a bottom, we look for a strong move in the indexes on higher volume than the prior day, preferably day 4 through 7 off the bottom so that it's not confused with short covering. We got day 8, closer to day 4 to 7, the better. And normally it's accompanied by leading stocks breaking out of bases on heavy volume. We had one component missing today, and I'll talk about that as we progress through the video. Let's check the trend gauge over here. Market leaders got off of bearish and to neutral. This is at a minimum. We do have leading stocks with good price action. The volume action is what was questionable today, and we'll review that when we get to the tail of the tape. Short-term trend, we're still showing the red arrow, but the green sub arrow. We need 2 closes above the 21 before we change our trend, and we also don't want to see this follow-through day fail miserably. Now what we look for is distribution. A distribution day meaning a down day on higher volume than today or any prior day. If it happens over the next 3 days, it calls the rally into question. So we've got a lot of rules that kick in that we'll need to be monitoring. But that's why we're still on red there with the green sub arrow. Same thing for medium term. We got above the 50-day moving average on the NASDAQ 100 and the S&P 500. With the strength that we got today, red sub arrow, again, we need to at least 2 closes, preferably a weekly close above the 50-day moving average. Long term, no problem there. Still above all the 200-day moving average on all 5 of the major indexes. And again, a reminder why we didn't take our exposure down to 0. We kept a few positions, small positions, and our big core position in the S&P 500 because you can't time the market on a day-to-day basis. And out of the blue, you get days like today, and we want to participate in those days when they happen. We don't want to be starting from 0. So we gave up a few percentage points of overall return after we broke the 50-day moving average, but recoup most of it today when you get a day with returns like today. So that's the explanation there. So what happened today? Day 8 follow-through day, but if you had to throw cold water on it, volume was light on most leaders. Here are the final numbers. Our 8 ETF composite up 2.2%, led by ARK-K up 5.4%. Great return there. And FFTY, that's the IBD 50 ETF, up 2.3%. We also saw high beta far outperform low volatility. The SPHB VTF up 2.14%, the HPLV low volatility up 0.4%. That's what we'd like to see as a risk on indicator. S&P 500 open flat. In fact, pretty much all of the indexes open flat. There was really no clue that we would end up with the strength that we did today, but that's why you have to keep an open mind in the market, where we never get locked into one mindset. Things can change at any time, and that was the case today. At 10 o'clock, some economic data came out that the market was extremely pleased with, and that kicked off the move to the upside. S&P 500 up 1.45%, NASDAQ 100 up 2.2%, Dow up 0.85, mid caps up 1.4. Pretty much the same for the Russell 2000. Small caps, Global 60/40 up a little over 1%. Bond prices up, bond yields down. This was one of the things that triggered the rally also, and we've been mentioning we need to see weakness in the dollar and weakness in rates, and we got them both today. And that followed through with market strength based on that and based on great action out of the Big Seven. In-house GROTECTION up 1.18%, give or take. Let's move on to the charts, and here we will start with, as usual, the S&P 500. So let's start counting backwards. Let's go to a 15-minute chart here. 8 days ago, we had this put in the bottom. We gapped down in the morning. We rallied into the close, and this was day one of the rally attempt. Let's go to a 60-minute chart, and you can see, actually, it's more clear on the 30-minute. You can see how we broke this 4450 level. I had been showing 4450 to 4458 as a level to watch. And this is technical analysis 101. It's 101. It's a classic case of support flipping to resistance, and then the market breaking back above that resistance to launch a new attempt at a rally. So you can see here where we broke back below it on the 15th, 16th, 17th, and the gap down on the 18th that put in the bottom. Then we started trying to trudge higher, making higher highs and higher lows. And then we had NVIDIA report, gapped up above that key 4450 level and stayed there for all of about 15 minutes, maybe an hour, before giving it up, falling back below that 4450 level, not making a new low, but resetting the short-term trend because we did make lower lows, but the rally's still intact because we didn't undercut the low of that day one. And now here we are. We had the Fed last week. We had the Jerome Powell, Jackson Hole speech, Fed Chief Jerome Powell's Jackson Hole speech, a lot of volatility. But by the end of the day, we closed higher. Followed through yesterday with a little bit of a move higher in the indexes, very tight range. And then today, that 10 o'clock news that came out was JOLTS, job openings, with a big miss. That means employers are pulling back. The Fed has been very concerned about wage inflation. If employees have the upper hand versus employers, there's going to be wage inflation, and that follows through into goods and services that are put on the market, and it's inflationary. But if an opening in jobs, a decrease in job openings means employers aren't hiring as much, it decreases labor wage pressure, and that follows through on reducing inflation. And the net impact of that would be that the Fed doesn't have to raise rates or continue to raise rates if the economy is cooling off the way they wanted to. But the bottom line was the market was pretty much unanimous today, with rates coming off, the dollar coming off, and stocks going higher. And where do we pause? Right at that 4,500 level, which was the next level up for resistance, really normal spot. You can see we battled around that 4,500 area, which is kind of typical of round number levels. We played some ping pong there in early August. You can see at this area here. So normal spot to pause for today. You can also see that that area worked as support and resistance back in July when we first had that breakout on July 12th. We battled around that 4,500 area, broke above it, pulled back, tested it, and held. And then that was an area that we little by little gave up as we started pulling back at the beginning of August. But follow through day, above average volume, or much higher volume compared to yesterday, but not above average volume. But that's typical. This is usually the lightest trading day of the year because the big New York traders are in the Hamptons doing their last bit of partying into Labor Day before kids up north go back to school. And it's typically a light trading day, but it was pushed up today. We go by the rules. The rules were higher volume, day 8, follow through day, and we'll see where we go from here. Not a guarantee of anything. Follow through days fail all the time, but this is a good start, especially on the back of Jerome Powell's Jackson Hole testimony, his need for inflation to continue to cool, wage pressure to continue to come off, and the market dropped the odds of another rate increase by the end of the year to below 50%. All pieces of the puzzle that we try to put together every day in these videos, and but definitely a change in character, especially making a higher high after the big NVIDIA negative reversal. Here's the NASDAQ 100, same situation. We got unable to hold that 21-day. The whole way down, one close above it, a gap up and an epic fail, acted as resistance yesterday, but blasted through it and through the 50-day on the NASDAQ 100. Good stuff there. That's what we want. And pretty good volume on the NASDAQ QQQ. If you go to the MarketSmith homepage, this is where the final arbiter of the data resides, and as of right now, it's just marketsmith.investors.com. NASDAQ volume up 29.5% versus yesterday. NYSE volume up 13%, so below average, but well above yesterday's volume count, and that's the rule that gets applied. Onto the Dow, back above the 50 and the 21, good stuff there, up 0.85%. So 34,000 held, and we got back above this 34,600 level, which was resistance for quite a while before the Dow broke out on 718, subsequently failed, but the 200-day held and 34,000 held, so good stuff there. On to mid caps. Back above the 21, sitting basically right on the 50-day. They held their 200-day moving average the way they needed to, so we're getting cooperation from all 5 of the indexes. As you see, small caps here just barely closing above the 21, but did hold on to the 200-day the way it needed to over the last couple of weeks, and now we'll make an attempted move higher also. Important that we have to have cooperation by banks and oils in order for the small cap index to work its way higher. So those are the 5 major indexes. This move was also confirmed by the VIX, which made a lower low on this pullback below the 21, below the 50, and below that 15 level. Below the 15 level is where the indexes have had their best rally this year. From June to July, we spent most of the time under there before spiking above it at the beginning of August, which kicked off this correction. So glad to see the VIX back below. Dollar. Let's go to a 5-minute chart here, and you can see the dollar initially gapped up, but look at this big move down in the dollar after that 10 o'clock JOLTS data came out. Little spike higher and then sold off as the day went along. As the dollar was coming off, the indexes went higher. Let's look at the S&P 500 5-minute chart so you can see right at 10 o'clock where we had this little move up. We opened basically flat, started to work our way higher, but then big move up right at that 10 o'clock 5-minute bar, and then it was a trend up day for the rest of the day. So that's the VIX. We did the dollar. How did that trickle over to gold and silver stocks? Since the dollar was down, gold was up 1%, reclaiming its 50-day moving average. GDX gold stocks up 1.8%, regaining their 21-day moving average. Silver breaking out of this little 4-day tight pattern that it put in after gapping up last week. And we'll do Bitcoin. Bitcoin had some news today. The news was that Greenscale, which had sued the SEC, they have an ETF called GBTC that tracks Bitcoin, but it's an ETN. It's not an ETF. It trades over the counter. The SEC had not approved an ETF to be traded on the big exchanges, but they sued because the SEC approved BITO, which is a futures trading product, but they couldn't explain why they wouldn't allow a spot Bitcoin ETF. And the judge said, well, you can't apply different rules to essentially the same product. So this paves the way for the SEC to approve spot Bitcoin ETFs, and the whole Bitcoin related complex took off on the day, led by Coinbase, which is supposed to be kind of the exchange of record for Bitcoin pricing. And you can see this initially started, this talk started back in July when Bitcoin had a big spike up. Coinbase had just continually sold off. Since then, big wedge pop today. This is when a downtrend is decisively broken on a big up day on volume, and the volume was there also. So Bitcoin trying to regain its leadership, hooking up from oversold back above the 50 and the 21. Now let's flip to bonds. Here's BND, tight 4-day range, very clear break above it. Let's look at the 5-minute chart, because this is where the price of bonds ticked up. And if price is up, that means that yield is down. We'll flip to the TNX yield very quickly, and you can see the big drop in that at 10 o'clock Eastern time with that JOLTS data coming out. Let's flip to TLT. This is the long bond ETF, breaking above the 21-day moving average. You can see the 10 o'clock spike there on the 5-minute chart. And of course, you're going to see the corresponding drop down at 10 o'clock Eastern on the 5-minute chart in the yield. So yields dropping, good for stocks, dollar dropping, good for stocks. Bottom line is today was good for stocks. So that's all the inter-asset correlation that we hit in every video. Let's go to the tail of the tape. So market state, as we said, changed to uptrend. A couple of other changes here. The NASDAQ, McClellan Summation Index, RSI, was oversold. It hooked up today. This is probably one of our favorite secondary indicators coming off of oversold. You just see it time after time, the way this trends with the market. You want this as a tailwind, not as a headwind. Dollar breaking down from overbought, that's a benefit for stocks, and yields pulling back below their 21, that's good for stocks. So with the follow through day today, we flipped from the bear case to the bull case. We certainly don't want this follow through day to be given up, as we'll watch for any signs of distribution over the next couple of days. Here's the news: JOLTS well below expectation and the lowest since March of 2021. Also, consumer confidence was below expectations. Weak confidence implies less spending, implies less inflation, implies a Fed that can uh, let the economy cool off a bit and hopefully have a soft landing. So everything lining up for what the Fed wants to see. Day count from rally attempt day 7 to a day 8 follow through day confirmed. Second day above the 80 EMA, first back above the 21-day EMA. 11 out of 11 sectors up today. So that was a good sign, led by tech, Chuck, EXLCKY, semiconductors, and Bitcoin in the Bitcoin complex on the downside. Just the dollar in yields, which is just what we want to see. So what did we do in house today? As soon as those yields spiked, we got rid of our 2 hedges that were interest rate sensitive. We got rid of TBT and DRV. This was inverse interest rates and inverse real estate. Then we started looking at what's moving on volume. It was very obvious that Tesla was having a strong day on volume. We bought that. And then when we got back above the 21 and then the 50 and pulled back and held it, we did 2 buys on SPXL, which is the index, the 3 times index ETF. So taking up our exposure very quickly using this instrument, because the volume just wasn't there on many individual leaders today. But the net effect was we went from being under the 50-day moving average and our adjusted beta having a target ceiling of 1% back above the 50-day. Now that's a target floor of 1%. And these are just rules that I've developed over the years, depending on what the overall market's doing. If it's I have to participate. The worst thing that you can do as a portfolio manager is lag because of an opinion that you have. And I learned a long time to try to put my opinions aside, go with the pure numbers, go with the price and volume, and not be inflexible to what's going on. I certainly didn't come into today thinking that we were going to have a follow through day, but I was prepared as if we were going to. So the bottom line, 8-day follow through day, S&P and the NASDAQ back above their 21 and their 50, but volume light on most leaders. We're going to take a look at that in a second here. And now what will we watch? Certainly the 21 and the 50-day moving average on the S&P and the NASDAQ, and also uh, volume for leaders. We need that. And also critically, we need no distribution on the indexes. So here's what I mean by no volume on leaders. This is the 21 over 21 list. It's actually 22 stocks because Tesla was added today with us buying it. And if you sort it by volume change, only two of the names had significant volume up that would lead us to buy. Splunk, which we added on Friday, Light and Wonder, which we added a couple of weeks ago. And then the third one, DRV, this is something that we sold. So that's certainly not something that we're going to be buying. We also saw NVIDIA, already had that position. So we opted to add to Tesla, which volume waned a bit during the day. Price didn't. It closed near the highs of the day, but slightly above average volume there. Also slightly above average on Interactive Broker, which had a shakeout, still down 1.9%. But undercut and reclaim the 21-day moving average. Celsius, good stuff there. That's at the top of the buy list. But look at how light the volume is on the rest of these other names that we would consider looking for an entry on. Minus 23, 24, 25, 29, 30, 40, 55, 59, 60. There's no conviction in this volume, and there doesn't have to be on day one. It could come in little by little through the rest of the week, and we'll look for low risk entry points. We'll take small buys at first, but we've got our big position in the indexes as long as that continues to act well. And it's not exactly easy to find a bunch of stocks that are going to outperform 2 times the S&P 500, let alone 1 time. So uh, we're happy with that. And then we've also got the 3 time in SPXL that we bought today. So now we need a big leader to stand up and say, I can crush the indexes. The last up move that we had, we own 3 of them, Tesla, NVIDIA, and SMCI. SMCI failed on its earnings report. We got stopped on Tesla when it broke its moving averages, but let's take a look at that chart right now because it regained them today. The 21-day had been resistance on Tesla over the last week and a half. Volume patterns were turning favorable, so that got it on our watch list, and then it blasted above the 21 right into the 50-day moving average today. So that's the next level that Tesla needs to overcome. Let's look at NVIDIA. Great action here. An all-time closing high. So after the big negative reversal on its earnings report, all it did is come down. Now the volume was heavy, came down, held its 21-day moving average, bounced last 2 days on above average volume, all-time closing highs. We'll be looking to add to this at any opportunity that we have, and then we'll go shopping on the rest of the 21 over 21 list or anything else that jumps out to us. I got a question today. Why do we have over 30% cash in the portfolio? And the reason for that is we've got 20% in T-bills. We don't want to stick it all into T-bills because T-bills are a bit on uh, there has to be a bid there for you to sell the individual T-bill. So that 20% is, we kind of consider that locked up for the next month, and that's not a problem because we use leveraged index ETFs. We can take the difference between buying the single ETF and put that into T-bills, which then leaves us with the decision of what we're going to do with the rest of the portfolio. The fact that we had bottomed and put in, we're in the process of rallying, we want to have cash available. If we put it into either a money market mutual fund that's higher yield or into the ETFs that are money market ETFs, we have to wait 2 days for those to settle Or if we take that money and risk buying something, we can't sell it until those ETFs settle. So that's why we don't just plunge all of our spare cash into ETFs. 5% for a year, we can make 5% in a day in some of these names that if we get proper entry points on them. So it's always a delicate balance between what you want to do with your cash, putting it into T-bills, T-bill ETFs, T-bill mutual funds, or keeping it available for buying opportunities. And with us being in the early days of a rally, we wanted to have it available to put it to use, and we did put some of it to use today. So that's the explanation on that. And with that, I'm going to wrap up today's video. Remember, it's not how much you make in the market, it's how much of that you can keep. Hopefully today's rally holds for the bulls. If it does, we can go from we go off of the protection part of GROTECTION and back to the growth part of GROTECTION. Kept our powder dry. Our drawdown was within 1% of the S&P's drawdown. That's a pretty good performance for an active portfolio. And now we get in the right stocks at the right entry points, low risk entry points. We know from history that we can well outperform the indexes and certainly outperform 60/40, which we crush on a long-term basis. So with that, I'm going to wrap it up. You have any questions, you can email me, don@revereasset.com. If you're interested in becoming a client, check out my partner, Dan Stewart, at dan@revereasset.com. The phone is 855-REAL-WEALTH. That's 855-732-5932. And I will close up the video for Tuesday, August 29th, follow through day Tuesday. Let's see what the rest of the week brings. This is Don Vandenbord with Revere Asset, telling it like it is. Thanks for listening and have a great day.